MBA Finance for Business Managers, Financial Analysis of Next PLC podcast by Chloe Harris. This report aims to critically appraise Next PLC annual reports and financial statements of accounts for the years 2016, 2017, 2018 and 2019 in order to provide highlights and trends with reference to current information to assess the organisation's future performance. A critical analysis of key findings regarding the financial ratios conducted for Next PLC have been comprised below in order to accurately assess the organisation's future performance and provide detailed recommendations to investors as to if investment in the company should be made. Looking into profitability ratios, by the comparison presented, it can be deemed that there is a significant return on investment regarding Next PLC of 107% in 2019. However, contrasting years indicate a significant decline of 107% from 2016 to 2019. Similarities based on the ratio analysis for return on capital employed for Next PLC. It can be shown that the organisation is stable in regards to its margins, although receiving a decline in recent years. The profitability margin remains high. Drawing homage from the gross profit margin and operating profit margin, Next PLC is experiencing a favourable profit margin for investment. However, the concern is shown by the 1% decline almost each year. This being due to the decline in year-end profits continuously from the 4 residing years, as stated in the annual reports and financial statements for each year. Although the decline has been narrow, this has provided this 1% impact year on year. Liquidity ratios are the measurable functions of the ability an organisation can meet its short-term debt obligations, thusly indicating the number of times or days the short-term obligations can be covered by cash or liquidated assets. The working capital ratio within the current market that the percentages presented are exceeding the needs of repaying any underlying short-term debt the company has incurred as much as 208% in 2019. Therefore, the ratio being greater than 100% indicates that the business is not utilising its cash effectively. Per contra, the organisation is more than equipped in repaying all outstanding debts. Based on the acid test ratio, Next PLC have strong indicators that current liabilities can be paid within the expected timescale. This given that the current stock assets, which are significantly larger than the liabilities present, contributing to the larger percentage. Drawing from the day's analyses in section 6.2.1, 6.2.2 and 6.2.3 show that the margins are not a significant cause for concern. However, issues with stock management and a high margin for debt collection can be improved to provide a better outcome in the future. The gearing ratio or capital gearing refers to the amount of debt a company has, compared to the equity held, providing industry margins between 25 and 50%, being optimal. However, regarding Next PLC, given the percentage rates acquired from the gearing ratio conducted, it would be deemed that the organisation is high financial risk to lenders and investors. Similarly, with interest cover ratio, Next PLC are able to cover their interest payments 19 times for 2019, which is more than sufficient. Yet, this is a decline from previous years due to the rise in payable interest the organisation owes. Moving on to investor ratios and the dividend per share, Next PLC are meeting the expectations of their shareholders due to the 0.05 pence increase in the dividends per share and the stability over the 4-year period presented. The dividend payout ratio shows a measurement of performance health indicators for dividend payout would be considered between 35 and 50%. Therefore, based on these performance indicators, Next PLC is not meeting the average requirements for dividends being paid to its shareholders, and in the year 2017 and 2018 experienced a 6% and 8% decline respectively. Although the percentage margins remain relatively constant, they do not meet the industry average. Dividend yields enable investors to evaluate shareholder dividends paid and retained profit. The optimal yield expected from shareholders is between 4 and 6%. Next PLC's dividend yield ratio analysis show indicators of underperformance. Thusly, due to this lower yield may not be enough justification for investors to buy into the organisation, and staggered rate and performance margin year on year does not provide a promising investment. The recommendation to the company based on the evaluation of the Next PLC organisation would be to not invest in the business. Taking considerations of the brand strength and position in the market, the lack of investment into online sales and distribution in earlier years is now providing a response to the changing markets and economic tolls the UK retail industry has suffered in recent years. Next PLC must now compile a new strategic direction in order to anticipate the market change and customer segmentation in order to remain competitive within the market and meet the demands of consumers.